Hi, good evening, everyone. My name is Gerald, and I'll be your host for tonight's Corporate Connect. We are very pleased to have with us the management of IREIT Global with us for tonight's Corporate Connect seminar. This webinar is organized by SIAS and supported by the SGX Group. We're also very pleased to welcome the audience from Mumu Live. So for those of you who might not be familiar with IREIT, it has a portfolio of freehold, office, as well as retail assets in Germany, Spain, and France. And we are very pleased to have both the CEO as well as CFO of IREIT Global with us today. Before we actually go into the presentation by the management, we will kickstart tonight's session with a market highlight segment by Mr. Jeff Howie, who is the market strategist at SGX Group. So without further ado, I'll hand over to Jeff, who has done this recording of the market update for us. Okay, so maybe we'll just take a bit of time to transit over to the market update. Okay, please bear with us as we transit to the market update.
Educative overview as well as relay some recent highlights in our SREIT market. Our SREIT market, as you would know, is one of the largest in Asia. It has around 40 trusts that boast a combined market capitalization of as much as 90 billion Singapore dollars. And these trusts therefore represent around 10% of our overall stock market capitalization, and they as well as contribute to 18 cents in every dollar that changes hands on a day-to-day basis. REITs are diversified in many ways. The first, I think, which is of great interest, especially to the listeners and the viewers tonight, is where in the world they invest. In Singapore, as many as 16 of the trusts exclusively invest in property assets outside of Singapore. Then you have 19 of the trusts investing in properties in both Singapore and outside of Singapore. And then you have the remainder investing purely in Singapore. And with the international exposure, this includes as many as 13 REITs with properties in Europe and the UK. This includes IREIT Global, which has all its properties in Europe, Stoneweg European REIT, which has 97% of their properties in Europe and then 3% in the UK, and Elite UK Commercial REIT that has all its properties in the UK. The 13 also include the REITs like CapitaLand Integrated Commercial Trust, which, for instance, has just 3% of its portfolio's properties in Europe. The trusts also span various property types or sub-segments, and this includes, importantly, diversified properties. So you could have a mixture of these property types, which can include industrial, hospitality, retail, office, specialised, as well as healthcare-related properties. And the diversified REITs typically are made up of either industrial and commercial properties or commercial and retail properties. And in some cases, you could have up to 3 property types like commercial, retail, and hospitality, which I do believe IREIT Global now does maintain, with the UK's popular hotel chain Premier Travel Inn now on their tenant list in Berlin. So looking at some of these key stats on the slide, the FTSE ST REIT index has delivered a 10-year total return of 37% through the end of February. The average gearing ratio for the S-REITs is at 39.6%. That's well within the regulated limit of 50%. And the average distribution yield for the S-REITs stands at 6.9%, which is significantly higher than other asset classes. I think the 5 S-REITs that maintain the highest distribution yields as of the end of February were IREIT Global, Elite UK REIT, Stoneweg European REIT, First REIT, and ESR REIT. Last week, the S-REIT sector booked 42.5 million Singapore dollars of net institutional inflow. This was the highest weekly net institutional inflow for this sector since the week beginning the 2nd of December of last year. And this was also the first time the sector booked weekly back-to-back net institutional inflows in close to 6 months. Over the past 2 weeks, the sector saw a total of around 80 million Singapore dollars in net institutional inflows. And for each of the 2 weeks, around half the sector actually did book the net institutional inflows. You can see the impact of the Fed funds rate on the overall IHS REIT index benchmark in this chart, with the December Fed fund futures represented by the green dotted line and the IHS REIT index represented by the strong blue line. And your current consensus is for 75 basis points of cuts over the remaining 6 FOMC meetings in the US before next year. And that's significantly more dovish than the expectations of only 25 basis points of cuts that was being touted something like 5 weeks ago. So you've had a little bit of a change in the scenery in the US from the economic perspective, with a number of data prints coming in quite weak. The FOMC, your OECD economic outlook, both last week, downwardly revised GDP growth estimates for the US this year. We saw the US Conference Board consumer gauge, that I think that was at an 8-month low. The University of Michigan consumer gauge was at a 27-month low. And you've got this reduced confidence, which is really about the recognition that your broader strategic policies in the US are going to entail some short-term pain as the US economy is redirected towards I guess, a more sustainable path to reduce its fiscal and its trade deficits. And at the same time, you've got that familiar overarching theme of inflation, which also remains a persistent concern in the US, unlike it is here in Singapore. And in the US, it is yet to reach that desired 2% threshold. So these are some aspects that have been driving overall broad participation and broad flows into the market. But as we said, the last 2 weeks have been seen this little recovery here on the slide I can show you, up from these lows that we saw earlier in March. Looking at the S-REITs over the last 2 weeks, I guess that saw the highest net institutional inflow proportionate or relative to the size of the REIT. So in this instance, you're taking 2 weeks of net institutional inflow into Parkway Life, which was $10.7 million. You divide that by the size of the REIT, the market cap of the Parkway Life REIT, and that comes to 0.4%. So these are the REITs that have seen the highest, as I said, net institutional inflows proportionate to their overall size. Parkway Life's obviously known for its focus on healthcare properties. Obviously, it includes hospitals, healthcare facilities, ancillary clinics, which in recent years also showed some resilience during the economic downturns, and by extension, you can see it maintains the highest valuation in terms of price to book ratio across these REITs that booked the most relative net institutional inflow over the past 2 weeks. Keppel REIT is their number 2, primarily invests in commercial properties across business districts in Singapore and Australia, and it seemed to have high quality assets in these strategic locations, very relevant to the pace of office demand. And Fraser Centrepoint Trust focuses on retail properties, particularly suburban malls here in Singapore, and its tenant mix, its occupancy rates have also made it, I guess, a relevant forum or a relevant medium for investors that want to capitalize on the steady footfall and consumer spending in suburban areas of Singapore. United Hampshire US REIT, that invests in grocery-anchored, necessity-based retail properties in the US, and that enables it to provide an element of stability in its income streams and makes it relevant to institutional investors also seeking exposure into the US retail market. And then you've got CDL Hospitality Trust as well, which, as you know, invests in hospitality assets, hotels and resorts across Asia, Australia, and Europe. So these statistics, they're this column here is really just based on 2 weeks of flows. However, you can see when you look at these dozen REITs in the table, they generally have a median price to book ratio of 0.93 to be exact, and that compares to 0.72 for the entire REIT sector. So you could tentatively conclude that the rotation over the past 2 weeks, it would not appear to be part of a larger value trade or a rotation into value stocks, and it's more subject or following the recent performances in the unit prices. I think in the month to date, ending on the 21st of March, the IHS REIT index had actually recorded a 5.2% total return, so it had outperformed the STI 1%, and the FTSE EPRA IREIT Global REIT Index declined of 4.4%. So as we said last week, that S-REIT sector booked $42.5 million on Singapore terms of net institutional inflow. That was the highest weekly net inflow since the week beginning of the 2nd December. It was also the first time, as we said, the sector booked the weekly back-to-back net institutional inflows. You could also look at some of the REITs that have been with us for the 5 REIT ETFs that we have listed on SGX. They have combined assets under management now above 1 billion. It's actually 1.1 billion Singapore dollars. They've had inflows so far in the year to date of around 77 million Singapore dollars, and that follows up from around 180 million Singapore dollars of net institutional inflows last year. And in terms of trading turnover, they're trading at around $3.3 million so far this month, which is up around 25% from around this time last year when we took the same gauge for the flows of the market. So definitely in focus, and we've also increased our frequency on REITwatch to every week. I think we took a little while there where we're doing it every second week. And do follow it on Telegram as well as on our website if you'd like to keep posted. And I'll finish just here. Thanks very much.
Hey, I hope the sharing on the Singapore market update was helpful for all our participants. Next, we'll invite the management of IREIT Global to share their presentation. With us, we've got the CEO, Peter, who will be providing the presentation, and their CFO, Kevin, would be around to be taking questions as well. So hand over to you, Peter.
Thank you. Hello, everyone. I'm very pleased to share this moment with you and to provide some this general information regarding our REIT. So it's a pure play Western Europe focused REIT, as it was mentioned by on the market research previously. So we are the only one investing purely in Europe so far. It invests in office, retail, industrial, including logistics and hospitality purposes. And it is important to remind that IREIT specificity is also to have 2 joint sponsors. First one, City Development Limited, which is well Singapore, which is what Hospitality Trust they manage directly, and they have big stake both in the REIT and the manager of IREIT, and they provide their support. Now they've been provided, support the REIT being a joint sponsor for 7 years now, and they are very keen with this exposure, this investment, and they are very, very reliable joint sponsor for our REIT. On top of this local investor, I would say there is Tikeo Capital. Tikeo Capital is French-funded capital investment firm. So it was funded 21 years ago, but it is now a worldwide company having around 50 billion euros of asset under management, among which 15 billion euros, roughly 1/5, are based composed of real estate, including IREIT. There are other investment activities relate to private debt, private equity, and listed strategy, capital market strategies. What is important to have in mind that these two joint sponsors have an extensive experience of real estate, but also extensive presence, as CDL has a footprint and teams in Europe. Tikeo has offices in all the main cities and, let's say, main capitals in Europe, which allows to have a very good network with all the necessary third parties to work on this industry, real estate industry. So very long experience, very extensive footprint, and a lot of resources dedicated to this activity. And we really support in Spain. You can see on the chart on the right the spread, how it is a spread between countries. So our main exposure in terms of countries is Germany with 61%. Then we have France with 24%, only composed of retail properties, and we have Spain with office properties as well. You can see some awards and accolades because we have received some awards, and we are proud to share them with you, of course. Total valuation of the portfolio was end of 24, 857 million euros. I would say steady on a year-on-year basis, but slightly improving on the 6 months basis. But we will see further details on that later in the presentation. The next slide, please. Yes, thank you. Just a word, further words on the portfolio. Just to mention that our assets are based in big or near big cities in Europe for Germany and Spain. So for our office portfolios, we have our Berlin assets. We will talk later in the presentation with a dedicated moment for this asset. So Berlin, the federal capital of Germany. Then we have Bonn, an asset with the Deutsche Telekom as a tenant. Bonn is the former federal capital of Germany, and it still has many governmental agencies which has footprints there, a lot of office requirements for their needs. We then have Darmstadt, which is very close to Frankfurt. So Frankfurt is a major town in Germany as well. It's where we have the stock exchange, Deutsche Börse. It's where you have the biggest German airport as well. So we have our asset there too, next to this big city. Münster is also less known, but it's a big city in Germany with 350,000 inhabitants, which is big for Germany. And our last one is near Munich, München, which is another of the big seven cities in Germany. And in Spain, you can see the four of them. We have two assets in Madrid, so the capital, and two assets in Barcelona, which is the second biggest town in Spain. So just to show you that we have good location, globally speaking, for our assets. And of course, this is really important, as in real estate, location is the first, is the priority. And then we have our retail portfolios, so two of them, one with Decathlon as tenant on 27 assets, and one with B&M on 17 assets. So there we have a different configuration. Our assets are located in more secondary or even tertiary towns, but they are located in retail parks, in the dominant retail parks nearing these towns. And in France, these retail parks are very, very powerful. It's not only in France, actually. You have this kind of retail parks also in Germany, for example. And this is really a good location to have retail assets. And if Decathlon and B&M, which are big tenants, big firms, have chosen also to be there, it's also an evidence that these locations are quite good. The interest of these retail parks is that you can provide shopping areas, I would say, at quite a competitive rent, because these are most of the time light, or I would say lighter buildings than office ones, because you have some steel structures with some coatings, and it's not very expensive to build and neither to maintain. So you can provide affordable rents to the tenants, which on their side can also provide affordable products to their clients. And this business model is working very well in France. That's why these retail parks are very strong, and that actually they are quite a certain number of transactions on these retail parks. It's very sought after by the real estate investors, because it's quite interesting. One last word, our occupancy on our portfolio, occupancy rate is 88.5%, currently increasing. We will see that just after. This excludes Berlin assets, which is now under a repositioning project, as we will see just after. Next slide, please. Okay, a few words on our full year 24 performance. Distribution is slightly increasing of 1.6% year on year at 1.90 euro cents. This is mainly due, but we'll see this in more detail later, to the full contribution of our B&M portfolio, which was acquired in 23, and higher rents on the Berlin asset and the Decathlon portfolio. Our weighted average lease expiry is steady at 5.9 years, steady but slightly improving due to longer lease signed in the last, in the year. This is compared to a third quarter, so in the last quarter of 24. Our aggregate leverage is quite low compared to the market, to the peers at 37.6%. But keep in mind that it will increase with our Berlin project, repositioning project, which requires investing CapEx. We'll see this just after. And this will be funded by debt. So our aggregate leverage will increase in the coming months. But currently it is quite at a low level, and this is because it is at a low level that we also have the capacity to increase our debt exposure for our Berlin repositioning project. And lastly, the weighted average interest rate is 1.9%, so quite low as well. This is linked to aging we have on nearly all our assets. But there too, have in mind that on the one side, we will increase our debt for our Berlin project, and on the on the other hand, sorry, we will have refinancing in the short term. We are currently discussing with banks regarding the loan, the senior loan on our German and Spanish portfolios, and this will end probably with an increase in our all-in interest rate in the coming months. Next slide, please. Okay. Quick focus on the Berlin asset, which is undergoing currently a repositioning project. A few words on this asset. So first, this is the biggest asset of IREIT, nearly 80,000 square meters. So it's a big stake with this project on this asset, and we are spending a lot of hours preparing, securing things properly on this asset because there is a lot of at stake. This asset was built in 1994 for purpose for the former tenant called DRV, which is still a kind of pension fund, insurance pension fund, German one, state-owned, and after 30 years of occupancy in this asset, they announced us in late 2023 that they will vacate end of 24 the asset. So for several months after studying the situation, taking into account the current state of the asset, the current state of the market, with regard to transactions, with regard to lettings, etc., taking a lot of advice to our operating partners internally as well, with our joint sponsors, sharing with our board members as well. We all reached the conclusion that the best project for this asset was to fully refurbish it, while repositioning it to, from a single let and a single use, office use asset to a multi-let mixed use asset, taking advantage of the current traction on the hospitality sector, while using the flexibility offered by the urban planning, authorizing us to accommodate hospitality operators in this asset. So the main tenant vacated end of last year, but at the same time, we managed to secure two long-term leases with two hospitality operators, which altogether represent now 24% of the lettable area of the asset. And these two hospitality operators are committed on a 20 years lease contract without any break option, so very, very long commitment. And we are actually now preparing the works to build these two hotels in our asset, combined with all the entrance of the assets which would be refurbished at the same time. So we are going to launch this works as soon as our building permit is obtained, and actually it is obtained, and we are currently in an observation period, which is a period when third parties can claim against this building permit, but we do not expect to have any issue on that. The municipalities you an ID. Normally, obtaining a building permit for such a project takes more than 12 months. It's very set. Two very important advantages with the asset of these assets are first its location. So it's not a prime location, but it is located next to the second biggest railway station, Ostkreuzbahnhof of Berlin. And this station is a hub where many subway and S-Bahn and U-Bahn, so the two types of trains circulating there, are crossing, and it allows all any Berlin inhabitant to reach this railway in a very easy and fast way. And this is really important because this location allows to reach, for example, the new Berlin airport, in 18 minutes, 8, so it's very short, and the center of Berlin in 15 minutes, so it's very short as well. That is why we have our two hospital operators who immediately seized the opportunity of securing this location, and this is also sought after by office tenants, and this allows me to disclose the second advantage of this asset is that we can propose and we can offer the tenants a very, very competitive quality cost ratio. To give you an idea as well, we are aiming an average rent on this area at around 25 euro meter per month. This is something that it's impossible to have with the new asset, fully refurbished asset from ours, which is new and which was delivered a few months ago. They are proposing a rent at more than 35 euro per square meter per month, so it's 40% more. And I mean, our asset is very, very competitive. I mean, the plan we have for our asset, our refurbishment plan, the campus vision we propose is very, very appealing at a very, very competitive price. So altogether, these are these advantages of this asset. And we are currently having very, very good discussions with actually four potential office tenants, but two of them are very, very big ones. And we are confident that we will be able to secure at least one of them. One of them could take up to the whole remaining areas of the asset. So we are working on them with our architect teams to see how to implement their specification into our office so that we propose the best layout to them. More details will be provided on this asset during an EGM to be convened very soon. We will be circulating the circular also for this EGM very soon, and we will have a dedicated time during this EGM to give further detail on the asset. But this was what I wanted to tell you today. All the same, with regard to the total capex of this project, it's ranging between 165 million euro and 180 million euro. So it's a big amount of money, but it's because we have a lot of area in this asset. If you look at the cost per square meter in the asset, it's not big. It's so big, it's quite usual for fit out, I would say classical fit outs. It's a bit higher because we have to refit all the entrance hall and to change a bit the areas for the hospitality side, where we had to add kitchenettes, kitchens, bathrooms, more common area, etc. So it's a bit more expensive, but the figure is not very expensive, globally speaking, when you look at the price per square meter. And this is something I want to highlight as well, that we keep most of the asset as much as possible, the existing, keep all the shell and core of the asset. We do not rebuild everything from greenfield. And this is why our asset will have very good ESG credentials when the works are over. Credentials like BREEAM, LEED, etc., which are also very important for our potential tenants. We are currently on the funding side, so working on the first tranche of works. So it's 82 million euros for the two hospitality tenants, hospitality areas, plus the entrance entrance area. So we are talking about 82 million euros, and we are about to raise money in the coming weeks to fund these works. It will be done by bond issuance combined with shareholder loan from our joint sponsor, probably. Bond issuance will be backed up by our joint as well, meaning that they are fully supporting of the project and taking their part of the financial commitment in this asset. Next slide, please. So I will maybe go quicker for the following slides. Coming back on financial performance, just to say in a rough words that gross revenue is bigger than the income to be distributed to unit holders, because it has improved due to a one-off dilapidation cost paid by a DRV, so the Berlin tenant which vacated the asset. So it's kind of a reinstatement penalty for leaving the asset in a bad state, I would say. As it was purposeless to ask them to reinstate the asset, as we were to refurbish it, we negotiated with them a dilapidation. We also had, so we had higher gross revenue, but this dilapidation cost was retained, not distributed, to keep money to fund the capex of Berlin. Besides, on the expenses, we had a one-off cost of 6.7 million euro, if I'm not wrong, for Berlin asset. It was so it has, but it was a one-off. So the big increase of 46% of operating expenses are one-off expenses. So at the end, we have increase in the income to be distributed to unit holders, but it's a slight increase of 1.5%. Next slide, please. Okay, just to say that the distribution payment date will be on the day after tomorrow, 27th of March. On that slide, next one, please. Okay, on the financial position, just to say that our NAV per unit in euro has decreased by 4.9%. It is linked to a decrease in the value of the asset, which we can see in the first line, investment properties, 1.9%. And also there is a decrease in the liabilities as we reimbursed part of our Spanish loan when we divested Illumina in 2024, which was the fifth office asset in Spain. We have a currency exchange effect on the single NAV per unit in single. So we are at 8.3% decrease. But just wanted to say a word that on the discount to NAV, which is today at nearly 52% discount. So it's quite low. I think that it is linked to, of course, our Berlin project. We'll first reduce, of course, the income for the 2 coming years, and so reduce the distribution. I think it is also linked maybe to the fact that we lack some information. Maybe you lack some information, investors, on this project. So we are providing this information. The EGM coming soon, we provide information so that you have the full picture, full figures, etc. I think so. It will improve the situation. And by the way, oh, I have a message. So I'm a bit too long. How long can I still speak? But I'm near the end, actually. Just me. If I have I still have 1 or 2 minutes, I go on.
Yes, Peter,
But
please
just
go
on
on.
that topic, yes. Yeah. Okay, thank you. On that topic, I think that this 52% discount to NAV is a real restoring force for the share price. I think we are very low. It's historical low. I think that we are bottoming now at this level, and my feeling is that it will not go further below. Next slide, please. Okay, on that, just a word to say that, as I mentioned before, our 2 maturing loans, the soonest maturing loans are the German and Spanish one, beginning and end of 26. We are, and these are the 2 biggest ones. We are currently discussing with the banks to amend and extend them. This will be done during our first half of 25. So we have already signed the term sheet, for example, for the German portfolio. So now we are on the final stages of the renewals. So it's good to know that we will secure these coming maturities, and that we will postpone to a much later date of this big amount of debt. Of course, this will, we will have an increase in our weighted average interest rate. But the caps and the swaps of our German and Spanish current loan will be maintained until the maturing, until the end date. Next slide. Next slide, sorry. Okay, maybe this one we can skip. Next slide, please. Okay, just one word to say that we have a small decrease in the value of our valuation of our assets on 24 on the 12-month basis, but on a 6-month basis, so from end of June to end of December, it's good to see that we are slightly increasing, but let's say that we are steady, showing that yes, on the side as well, when the valuers take into account the vacancy of Berlin and have been taking it into account since the last 12 months. So it's already priced in the valuation and of course. Can you hear me?
Yes, Peter, you were muted just
Sorry,
now.
my connection has frozen, so my screen has frozen. Okay, just to say that we have no big maturing loans, maturing lease contracts as well. I mean, the biggest one was DRV, the tenant who left Berlin asset end of last year. Now we have quite a well staggered lease profile. And with our new tenants coming in Berlin, we will also have a very, very long WALE because we aim at signing between 15 to 20-year-long lease contract on the office side as well. Next slide. Good traction on our other assets of the portfolio. So we signed nearly 50,000 square meters of new leases and renewals in 2024. This, of course, includes the 20,000 square meters of the hospitality operators with hospitality operators in Berlin. The new leases are nearly 10 years long contract. So it's to show that we can secure long-term lease contract, and this is quite good. We benefited from rental escalation due to CPI indexation of 5.8% on the existing lease contract. And of course, as we have very good tenants, we have no rent collection issues. So 100% of our rents are paid, and this is quite good news. And what I wanted to add is that we are currently working with a lot of potential tenants on our Spanish and other German properties. And we see and we feel good traction on our asset. And we are quite confident that we will increase the occupancy rate in the near future. So it's quite good news, yes, on the tenant demand. Next slide, please. Secure three things: secure our Berlin asset repositioning project and secure as soon as possible office tenants. Second, improve our occupancy rate, keep improving our occupancy rate on the rest of the portfolio. And third, once these two first has been completed, we will think about increasing the size of the again, increasing our portfolio to improve diversity on the portfolio, but also to improve at corporate level, I would say the liquidity of the share, to improve our rating, to improve our funding costs, etc. So we need to grow for that, and this will be our third priority. Thank you.
Thank you, Peter, for the update. So now we'll jump into the Q&A session. We already have many questions that were pre-submitted. If you'd like to ask a question to the management of IREIT Global, you can submit it if you have participated through the Zoom link as well. Okay, so I'll start with a pre-submitted question. Peter, earlier you spent quite a bit of time explaining the Berlin asset. Quite a number of questions relating to this. The question is, how will the redevelopment affect your distributions? And how should we think about the sensitivity of the distributions around your ability to secure new tenants for the Berlin asset?
Kevin, you want to answer this one?
Okay, sure. I mean, thank you, Gerald, and thank you everyone for attending the webinar. I mean, in terms of the DPU impact, I think Peter has earlier shared that given that DRV is the biggest tenant, and I mean when it was around, it contributes more than 20% of the group rental income. So as you can imagine, without the income from this tenant, I think even in our full year results presentation, we have mentioned that the distribution will be impacted. But I will urge investors and readers to look ahead in a longer term. There's a really attractive upside potential on this property. Peter has mentioned that we have already secured 2 hospitality leases, 20 years without break options, contributing almost 50% of the existing rental income from DRV by just these 2 tenants alone. So I think 24% net lettable area, but almost 50%. So I mean, in the near term, this year I think we have announced that we will be severely impacted. But I think once the repositioning is complete, and we have sort of announced in the when we sign the leases that the 2 leases will be operational towards maybe the first half of 2027. So this is something that we are working hard to complete. And of course, with the securing of office tenants, I think that will be very good news for everyone.
Do we have any forecast on how will the distributions be impacted with the repositioning of the Berlin asset?
Currently, no, but as you will see in the circular that will be published quite soon, we are targeting probably an EGM somewhere in April. So I will urge investors to look forward to our circular. In it, we will provide some kind of insights how the distribution will look like with the repositioning ongoing. So something that we will publish in due course, but not at this current moment.
Just to add a word on that, I mean, it's important to understand that, and this is not reflected in DPU. We are creating a lot of value for this asset. We will have, keep in mind that we will have in a few months, hopefully, a very well located asset in a very booming location, supported by the municipality, fully refurbished with good ESG, a very good ESG credential, and hopefully with 3, maybe 4 tenants locked for a very, very long period, very, very good tenants with, yes, very, I mean, AAA tenants, I would say. And this will create for core investors, potential core investors, and at least in the value of the asset, will increase a lot of it. So, of course, we will increase our DPU. We will increase our rental income. We will maybe not be, at least in the short term, be able to increase DPU as much as we want due to funding costs. So we have to keep that in mind. Today, funding our capex is still expensive. We are working on that to decrease the cost, but I mean it's of course obviously more expensive than a few years ago. But keep in mind that the value of the asset for core potential core investors, and this is what will value the valuers, will be very, very high, and this will improve the. We hope we consider that it will really improve the value of the asset and position it for the very long term. I mean, we will be free, at peace on this asset for at least 20 years without any capex. I mean, it will be very well at all points asset, very good asset.
Okay, thank you. Related question, but this came through live from CP Pua. The question is relating to the capex required. How will you actually fund the capex that's required for this project?
Maybe I can answer that at least on the principle. It's a very good question, and it's important that we are clear on that. We have already locked 2 tenants, 2 hospitality operators, and we are launching the works. We are about to launch the works on the areas related to these 2 tenants. And so we will raise money for that. So as I mentioned before, raise money via bond issuance and shareholder loan. And for the subsequent tranches of works and subsequent money raising, we would probably follow the same path. But what is important to have in mind is that we only raise money when we have secure tenants on specified areas. So it's not a speculative project at all. We lock tenants, we secure tenants, and then we raise money. And doing that, and this is our bet, I would say, doing that, it will ease money raising. If you have a tenant secured, of course, it's reassuring for a lender. And besides, when we have secured our office tenants, we will have nearly fully de-risked our asset. At this stage, we have 2 first tenants, hospitality operators, but it's 24% of the area which is secured. So it's better than nothing for a lender, but it remains kind of risky. Once we have secured our first big office tenant, the risk profile of the asset will dramatically change. And so it would be, we think that the possibilities, I mean, the ways to finance will be quite large when we have secured our office tenants and when we will need money to make the works. And we even think that a senior lender would be able to maybe refinance everything with the works because it would be fully de-risked. I mean, it will only there will only remain the works in themselves. But again, it's not a development project. It's merely fit out works on a very extensive area, and it's not sophisticated works. It's quite business as usual. Maybe you want to add a word, Kevin?
Well, I think you have summarized quite well. In my view, I have nothing to add.
Okay, a related question, more so on your capital management. I think given where your share price is, the REIT is trading at a discount to book. So this question from CP Paul once again, does it make more sense for you to be selling assets rather than acquiring assets from a capital management perspective?
Okay. We have asset plans for working on each asset, and we have plans on them. We are identifying, for instance, assets we consider as underperforming compared to our plan at acquisition, but also assets that are located in areas which we consider are becoming less appealing, etc., to tenants, or even assets which we consider that may concentrate too much risk on a single asset, for example, or single tenant. And of course, this sale plan, we have plans to sell some assets. The only drawback of selling assets in the current situation is that we do not really control the timeline. The liquidity is not completely there in the market. It's not completely come back, even if it's improving. And so you have two unknown, which is first the timeline, and second the price you will the price you will get from potential investor. So this is in our plan, but this is more on if you consider, for example, financing the capex of Berlin. This is not our number one scenario because it is not secured. You see, we do not control everything. So we prefer to rely on money raising in the market or with the support of our joint sponsor. And then, of course, when it comes to start reinvesting and maybe shifting a bit the portfolio to be less exposed to the office market, which is something we have in mind for the future, it can be both by investing through new money raising in new assets, but also, recycling capital. So we have this on our roadmap. It's included. Now we have to be able to execute, and this is what we are working on.
Okay, thank you. Can you share some background on the profile of the tenants that you're looking to have for the 5 properties in Germany? How much would hospitality take up of your tenant mix?
Okay, hospitality will represent we represent in let's say that pro forma they are in the portfolio today. They would represent around 8% of the total portfolio income. Today we have in our German portfolio a mix of tenants. So there are a lot of different ones, but often we have state-owned tenants, like in our Darmstadt property, for example, which was vacated 2 years ago, even 2.5 years ago. And now it's being progressively backfilled. It takes time because the tenant vacating occurred just after the COVID crisis, so it was a bit a bad moment. But we are backfilling it, and we have again state-owned tenant. We have banks, we have insurances. It's really a mix of different tenants. And we like that because, of course, this mix provides diversification to the portfolio and reduces the exposure to one sector or one tenant, etc. On our Spanish portfolio, for example, we have in one of our office assets, we have a data center. So we have an asset with a large underground area. And this was entirely rented by a data center operator, which is there for years and years, maybe 20 and even more years than that. And they are also occupying some floors or some office floors of the asset. So it's very diverse, and we like this, of course, because again, we want to secure our portfolio, reduce its risk, and so the more we diversify, the better we are.
Okay, thank you, Peter. And maybe just as a final question from David, who has joined us live, how should we think about the distributions, assuming no income from the new investment?
Assuming no income from the new investment?
Correct. So as it is based on your current portfolio.
So it's a bit back to the question of what is the impact of the absence of Berlin tenant at it.
Yeah.
So we will have a drop of DPU in 2025 for sure. In 2026, as well, considering that we remain as is in terms of portfolio due to the absence of this DRV tenant, which used to represent nearly 25% of our rental income. So let's say that from an NOI point of view, it would be a bit more, something like 30-35%. And this is what to be expected probably from a DPU point of view, DPU impact for the coming 2 years, considering that the rest of the portfolio is not changing, of course.
Okay, thank you.
Maybe one word. All our projects in Berlin project, and because we were talking about recycling capital, it does not preclude the possibility to sell the asset or partially sell it. I mean, this is one of our scenarios, and this could be done sooner than expected, I would say, because as soon as we have secured an office tenant, a big one. I mean, again, we have changed the risk profile of the asset, and even if the works are not done yet, the asset becomes sellable. And I mean, we think that we could find potential core investors for this kind of asset as soon as we have locked a tenant. And then if we sell even part of the asset, let's say 50%, this will completely change again things, because we would not have to finance the rest of the capex directly, because it will be paid by the investor, the co-investor, and then we'll be able to reinvest in other properties because we'll have proceeds more quickly. So DPU impact is mainly for 25, a priori for sure, but thinking further in time, it may be not completely relevant because there are many open scenarios in front of us.
Okay, thank you so much, Peter, for the explanation. With that, we have come to the end of today's Corporate Connect session. For all the participants who have joined us tonight, we hope that you found today's session helpful. In case you missed any part of today's session, you can actually rewatch the webinar on SIAS YouTube channel. For those of you who have joined the Corporate Connect for the first time, it is our bi-weekly webinar, and you can visit SIAS website to get updates on upcoming investor education events as well as initiatives. The next Corporate Connect will be happening next week, and we will be featuring Prime US REIT. So thank you so much once again for joining us tonight, and I hope you have a very pleasant evening. Thank you.